Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining us for today's webinar with Quantopian. But before we do get underway today, I'd like to begin with a quick audio check. So you'll see a control panel opened over on the right-hand side of your screen. I ask that you type a Y or a yes if you're able to hear me speaking. That lets me know that we are indeed connected and ready to get underway. Look at all of those yeses come in. Always good to see those before we do get started. Now, I also do want to remind you, well, first of all, there's a second reason I'm showing you that questions panel, because if you do have questions or comments throughout today's session, Delaney will be taking them at the end of his presentation. So if you've got those questions, make sure you add those into the questions panel. That's how you'll be able to communicate with us throughout today's session. Also want to remind you that we are going to be recording today's event, and each of you will get a direct link to today's recorded playback soon after the webinar ends. So if you do want to come back and review any of the concepts that Delaney is going to be going through today, simply watch your email for both the a link to the playback and the webinar notes or the slides that we'll be using today. So with that, let me pause for just a minute. I'm going to put this over on my disclosure slide, start that recording equipment, and we'll get underway. Well, hello, everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar, where we'll be taking a look at an idea to algorithm, the workflow behind developing a quantitative trading strategy. I'm very, very pleased to have Quantopian with us, Quantopian, who inspires talented people from around the world to write investment objectives. So I want to welcome all of the talented people who've joined our session here today. With that, what I am going to do is pass the or bring on both Phoebe and Phoebe Jordan and Paige Murphy with Quantopian to introduce our presenter today. So take it away, ladies.
Hi guys. So today's webinar, Idea to Algorithm, the full workflow behind developing a quantitative trading strategy, is with our own Director of Academia, Delaney McKenzie. As always, today's webinar will be recorded and it will be available to view on our website in the following days. So I just wanted to give a little bit on Delaney's background, which is in computer science, statistics, math, and computational genetics. As Director of Academia at Quantopian, he oversees the firm's worldwide educational and academic initiatives, while working with professors at schools including Princeton, MIT, Stanford, and Harvard. Delaney developed the free online Quantopian lecture series. The lecture series draws from academic rigor and industry realism and has since spawned a global workshop program teaching quantitative finance. Delaney currently focuses on maintaining the quality of these lectures as they grow, while also growing the audience of people who have learned from the lectures. He graduated from Princeton with a degree in computer science. So thanks, Delaney.
Thank you very much. And I just wanted to double check that everybody can see my screen. I don't know if I'm sharing it yet.
Not yet.
All right, I think I'm confusing this program here. Let me just quit out and sorry guys, give me 1 minute here. I'm going to try to share my screen.
Delaney, I have you as the presenter. Are you able to share your screen?
It's not showing me that option. Could you try like turning me off and back on again? I think that might be the simplest way to fix it.
Let me
Sorry.
see. Let me give that a try. Hold on a moment. Let me get back to my controls here. All right, I'm going to make you the presenter now. Do you see that button on your screen, Delaney, for you to share?
I'm looking. It's not prompting me. Like, it is showing me that I'm the presenter, but it's actually not prompting me to share my screen. I'm going to try one more thing. Let me quit this, and I'm going to rejoin the meeting if that's okay.
Okay, I'm going to make myself the presenter then, and as soon as I see you come back in, I'll pass those controls.
Really sorry about this, everybody. I'll be right back.
Okay, and while we're waiting for Delaney to rejoin the session, Andreas, I do want you to know we are going to be we are recording today's event, and you'll get a direct link to that recorded playback soon after the session ends. So you can come back and review concepts that Delaney is going to be going through here. Looks like he is back up and on the screen, so I'm going to pass this back over to Delaney, and let's get underway.
All right, thank you very much. Really sorry about that. I always joke that there's like two technologies that people have yet to perfect, which is audiovisual and Wi-Fi, and yet everybody uses those, and I have no idea why like market forces have not made those perfect yet. However, that said, thank you very much for the introductions. I'm going to dive right in the interest of time because there's a lot of stuff that I want to talk about. And for context, what I'm going to talk about today is really kind of a very high level overview of quantitative finance, and specifically the notion of going from an idea to an algorithm. And really at the end of the day, it's actually more going from an idea to making money. But that's a little bit, I think, almost like a too misleading or provocative title. So the idea is like, how do you turn your thought into money? Because that's really what a lot of quant finance is, and really what a lot of all jobs are. So I wanted to kind of go at a very high level over what that process looks like, because I find that a lot of resources end up focusing in on one specific part of that process, which is great. You need that. But I also find that being able to zoom out and understand the full landscape and the full context is really important. But first things first, just standard disclaimer, don't, this does not constitute investment advice, and don't go do anything stupid because you heard this presentation. But I want to start with this. This, I think, is an interesting example, and it gets at what I'm talking about when I talk about quant, because this is a loom circa pre-industrial revolution. And this is, very manual and hand operated. And, today we would look at something like this and be like, wow, that's basically completely antiquated. Some people still, produce artisanal cloth on hand looms, but it's very few and far between. And the interesting thing that's going on here is that we're in the middle of an industrial revolution in finance right now. And a lot of times people kind of think about quant and non-quant as two separate things, but I don't think that's a good distinction, because I think that quant fundamentally is just automation and putting more of the scientific process into whatever work you are doing. So as an example, if you look at something like this, which is an old-fashioned loom, over the Industrial Revolution, technology for weaving progressed a lot. This is kind of, I would say, halfway between what we have now, probably closer to what we have now than that hand-wound version. But this is an example of technology taking an existing process and making it faster, cheaper, and more reliable, right? So by kind of taking what people were manually doing and putting it into a process and being able to control it and understand that process and swap out parts modularly, in a modular fashion, everything got better. And to a large extent, a lot of quant is like that, right? It's that you don't necessarily have to completely invent something new. It's that you can just take existing processes that are already happening and automate them and make them cheaper and make them require fewer people to watch them, and you see that happening. You see Goldman Sachs now brands itself more as a technology organization, and they've been firing traders and hiring programmers because they're trying to automate their processes instead of having them carried out manually by hand. On the flip side, in quant, something else is that you can have inventions that are completely new and nobody's ever seen anything like this before. So this is an example of one of those inventions, probably the most significant invention of the Industrial Revolution, which was the steam engine. And the steam engine was remarkable because it was just an example of something that came out of nowhere. It was completely new technology. Nobody had ever done anything like this before, and it enabled not only travel over very great distances very quickly, but it enabled all sorts of machines to operate in industrial fashions, and just had far-reaching implications. So I bring this up because in general, automation kind of has two tiers of benefits, right? It can take existing processes, existing things, and make them cheaper, make them higher quality, faster, more reliable, all of the standard good stuff. And then on the flip side, automation and technology can also introduce new things that were just not even feasible or possible before. Towards that end, I wanted to talk about some examples of this in finance, because I want to say, okay, like I said, we're going through what I believe is an industrial revolution in finance right now. We're going through it in a lot of industries. A lot of industries are automating in some fashion. So what's happening in finance? Well, there's a ton of stuff happening in finance, but as an example, just as an example to kind of, I'm not going to talk about what everything is happening in finance, but as an example, here's an example of things that are cheaper and more reliable. So this is more fun live when I can have people try to guess what these are. But these are all ETFs. They're ETF products, and they track various different things. So I believe it's agriculture, livestock, timber, aluminum, and food for these ones, if I recall correctly from when I made this slide. And this is an example of taking something which historically would have been more expensive and more involved and less obvious, such as making a tracking portfolio, and then making that kind of very easy and cheap to buy into and reliable, right? So you can now buy into an ETF and be pretty assured that you can have pretty cheap exposure to the things that it claims to give you exposure to. Not always, but by and large. And imagine an investor in 1900, they probably just could not even have imagined having access to such a thing. And since then we've developed the technology manually, and then we've automated it. So we've kind of gone full life cycle on things like ETFs. And the other thing that's significant about ETFs is that really the definition of alpha and beta, and for those people who are not familiar, alpha and beta are very common terms in finance, and refers to the fact that generally what people do is they look for covariance between return streams. So if you have some new product and it has a very high covariance with existing products, you would say, well, it has beta exposure to those products. That's coming from the alpha and beta terms in a linear regression, which is the technique that actually used to determine the covariance, the beta. And alpha is what's unexplained. It's what's left over. And so generally in finance, beta is anything you can kind of buy cheaply on the market, right? Because if you come up to me with a new financial product and you say, hey, this thing is really interesting, it's doing a lot of new stuff, and then I look at it and it actually, is pretty completely correlated with an existing financial product, I would say, well, why would I buy your new product? Why would I pay more for that when there's this existing, probably cheaper financial product I can just buy? So as every new ETF gets introduced into the market these days, what is considered alpha is going to shrink because more and more beta is being introduced to the market. So on the one hand, what that means is that, things are just getting kind of simpler, more reliable. But on the flip side, like I said, there's always kind of two sides here. On the flip side, you're also going to have new types of investing open up, things that people had just never even thought of before, right? And so an example of something which is actually even probably a little bit passé now at this point, honestly, hedge funds tend to be pretty secretive about what some of their newest stuff is. And so it can be hard to know what the absolute bleeding edge is. But an example of something that, is kind of would have been considered crazy even as much as, 30, 40 years ago is basically using various satellite computer vision technologies to understand things like oil flow. So this is a picture of oil tanks from various locations. And the interesting thing about oil tanks is that the tops actually move up or down depending on how much oil is in them. And the reason for that is so that you can maintain a constant pressure inside the tank because, oil is very flammable, and if you leave too much space for air, you run a large risk of fire. So you can maintain a constant pressure inside the tank. And as a result, if you have a satellite looking down at these tanks, well, you know precisely where they are geographically. And so from there, you can say which way should the sun be shining and, where should the shadows be cast. And then from that, you can kind of basically make a little simple physics model that knows how high the tank lid is. And it's very easy, very reliable, very accurate. And so you can kind of know precisely how full any of these tanks are at any given time. And from that, you can imagine a tremendous amount of stuff that you could do with that data, whether it be making better decisions about commodities or understanding, where, countries are moving their oil pre-conflict, right? There's a example that I believe the company Terabella had, which was they were actually looking at Iranian oil supplies, which you can imagine Iran was not too happy with. And some countries, for instance, put in place the very highly sophisticated anti-technological solution of just putting a tent over their oil refineries or their oil tanks, which is one way to get around this. But you can imagine, again, like this is an example of increased sophistication. So I think with that in mind, I want to get into one of the kind of most pervasive new forms of increased sophistication that you see in quantitative finance, which is mathematical optimization. So mathematical optimization is, it's really a ubiquitous technique in many engineering disciplines, and I think has been introduced to finance with pretty great success, and for a multitude of reasons. At its core, mathematical optimization is just various, ways to solve the problem that is stated as follows. Given some function, f, that takes x as input, optimize, so maximize or minimize, let's say maximize for now, maximize the value f of x subject to constraints on x. So an example could be, very simple example, let's say that f of x was x squared, and you wanted to minimize the value of f of x subject to the constraint that x had to be at least 2. So that's an easy one. You would just say, okay, well, then x is 2, which is the lowest possible value that you can get with x squared if you constrain it that way. But you can imagine now that if you have like f being an unknown function, or f being a more complicated function, or f being a multivariate function, that it gets significantly more interesting. And you can see here, this is a picture example where you have x and y as inputs to this function e, not f. I apologize. This is the only picture I could find that was good looking like this. But you can see, like, as you vary x and y, you can see kind of the response that E has to various different values of X and Y. And in real life, oftentimes, we'll sample because E is some unknown function, or sometimes it's a closed form and we can compute it. But at the end of the day, what we're trying to do is we're trying to find a maximal or minimal point on this landscape. And again, this is a two-dimensional example, but in practice, oftentimes optimization will use, dozens or hundreds of variables in the function that it's trying to maximize. And it gets far more interesting, and obviously, human minds can't even conceive of that many dimensions, so we have to express it completely mathematically. Now, why is this interesting? Well, this is interesting because you can phrase, in general, kind of portfolio construction, which is at its core really investing, right? Investing is just about making bets, and when you're making bets, you're selecting assets to invest in, and the assets have, some expected return, and they have some risk associated with them, right? And of course, the secret sauce is all in computing that expected return. That's the hard part. That's the part which is really, kind of what everybody's trying to do. Although, of course, there's a whole host of things that you can do that are really interesting on the side of estimating risk. So both of those are hard tasks, but I think a lot of effort is put into the estimating return side of things. But once you have a function which has given a portfolio, like what is the estimated return on this portfolio, which for most people is your model that you're going to be developing, then maximize that function by trying, effectively lots of different possible values of portfolio weights. And I say this as general because, this doesn't just have to be equities or futures. It's like literally any portfolio, if you're choosing what real estate investments to make, whatever it is. You can kind of think of it this way. And then, of course, on the other side, then you can put in risk constraints. You can say that here are the constraints in my portfolio based on the risk that I'm willing to tolerate. So you can have constraints like I cannot be over-invested in any one position. I cannot have an excess bet in any one sector. I can't take on stocks who've had this much volatility in the last days. Like whatever the constraints you want to put in place, put them in place and then try to maximize your returns. So most quants operate within this bucket of try to estimate returns, try to estimate risk, and then do an optimization which optimizes for returns subject to risk constraints. And I think that's a really powerful way to solve this problem. And again, a very generalizable, elegant way to think about the investing problem that was only brought about by basically mathematical advances. So towards that end, just a little bit more intuition for optimization. You can think of it as a negotiation, and you'll see why this is important because I'm going to start getting to the high-level overview very, very shortly. And I think that it's really important to have a strong intuition for optimization and what it's doing. So for optimization, you can think of it as a negotiation. You can think of it as effectively that the optimizer is going to try, some value, some possible portfolio. It's going to say, let's try this portfolio. And it passes it to the function, and it says, okay, this portfolio, according to my expected returns function, is better than the last one we tried, so let's go with it. And then it says, okay, now constraints. Does this portfolio satisfy my constraints? And if the answer is yes, then it will kind of be like, okay, this is my new best portfolio, and let's keep walking from here. And if the constraints are like, no, this portfolio is too risky for some reason, then the optimizer says, okay, I'll try another one. And really all optimization is just variance on the way that you make those guesses. You can really think of it as really like intelligent guess and check, and all optimizers are just variance on what guesses you pick and kind of very clever mathematical ways to choose guesses. I think that's important to understand and just kind of keep in mind as we go forward. And there's actually a lot more information because, like it was mentioned earlier, we actually have a full free lecture series online at quantopian.com/lectures that we put a lot of time and effort into. And one of the lectures that we actually recently released was on risk-constrained portfolio optimization. The cool thing about our lectures is that we write them all on our platform so that they're all with code. So you can kind of read about it, but then there's the code next to it so you can see what would actually happen if you change the parameters in this portfolio and everything. So the goal with all of our lectures is by the end of them, not only do you understand the concept, but you can actually start re-implementing it yourself in real code. And if you're not comfortable with coding, we actually have intro lectures on coding as well on the platform at the start of the lecture series. So I just encourage people, if they're at all curious, to check that out in a much more hands-on fashion, because I find that when you really get hands-on and dig into this stuff is when you really learn. So now I'm actually going to jump into 3 perspectives on the quant workflow from a very high level. The first perspective is this. So let's talk about what it means to take an idea and turn it into money, because that's really, you know, again, like I said, any job you're doing ever is really trying to like turn, well, not all jobs, many jobs are trying to turn thought into money. What's the process for that in quant finance? And so the first thing you do is you think about it and you come up with an economic hypothesis. And so that economic hypothesis is really saying, I believe that this is true about the world. And, you know, it may be an economic hypothesis that like immediately says, okay, well then you could use it in this way to make money. And it may be an economic hypothesis which is a little less obvious as to how you could use this to make money long term. Both are ideas you may have. And you can kind of explore both to try to get down to a point where you feel like you could actually make money with it. But in general, for an economic hypothesis to be valuable, it has to make a prediction, right? And that's kind of at the end of the day what any hypothesis does, is it makes a prediction. And one thing that I find really helpful to think about here is think about how physicists view the world, because that is fundamentally what you're doing. You're kind of like a physicist whose domain is finance. And that's why, you know, quant finance hires so many physicists, is because the domains and the expertise is so similar between the two fields. And what you're doing is you're saying, I believe that I have a better understanding of the world than everybody else right now because of this new idea that I just had. And so the first thing you're going to do is you're going to kind of explore that idea. You're going to see, does it match up with reality? Let's see if it fits my data. And the important thing here is that you're doing testing on what's known as in-sample data. And so for those of you who are kind of, more statistics, data science familiar, I don't have to explain in and out of sample data. For those of you who are newer to the field, in-sample data is data that you use to kind of explore your ideas. But then because you've used it to explore your ideas, it's going to, like any idea that gets through your in-sample testing, by definition, has to look good on the in-sample data. It has to match it. So you can't use it to really test your ideas. To test your ideas, you need to get new data and test on that new data. But here you're exploring your ideas and you're kind of refining them as you go along. And then there's another step, which is once you think that your idea is predictive of what's happening, so like let's restrict it a little bit into like the equity space. Once you think you have a model that can predict equity pricing or equity returns, then you say, okay, now let's compare it to existing models. Because what might happen is you might have come up with like a model which is just a recreation of an existing known effect in the market, such as one of the Femme-French factors, or something else, like that, or a model that you already have and you're already trading. Because all of this is in isolation. And the thing that I like to say is the value of a model in quantitative finance, the value of an algorithm is relative. Because if I said, if you went to a car dealership and you said, what's the price of that car? The answer is, well, what are the other dealerships selling it for, right? The price of a good is only kind of relative to whatever you can get it for somewhere else. And towards that end, like I said, there's tons of models that already trade on the market. There's tons of effects that people know about. So whenever you come up with something new, you want to, of course, check to see like how it relates to the other stuff. Because if you've just rediscovered existing effects in some way, that's not useful. If it's something that's new and uncorrelated with what already exists, that's useful. And so from there, you can determine kind of like how you want to weight all of your different models, because that's the other thing. Rarely is one model going to be enough. Generally these days, like individual models that you come up with will have some predictive capacity, but the signal to noise ratio is going to be pretty low. And so to achieve a signal to noise ratio that's high enough that you can make, consistently good decisions, you have to combine a lot of different models so that their signals start adding up and piling up, and the noise keeps kind of averaging out with itself, which is this really nice effect that you get in model development statistics. Is the more models you add, the stronger signal to noise ratio you'll get, as long as they all have independently good signal to noise ratios. So you go through this loop of kind of exploring, refining, seeing how it looks compared to existing stuff, saying how should I trust it, compared to existing stuff, and then keep going through that loop. And then once you have something that you're pretty happy with, then the next step is you can get new data and do kind of a definitive testing step, an out-of-sample test. And this is, like I said, it's really important to do this because otherwise you can't really have true confidence that your idea is still holding up. And if you want more background on this, we have a lot more background in the lecture series, or you can kind of look up out-of-sample testing on the internet, like whatever you want to do, tons of resources available. It's not just finance, like every data-driven field has to deal with this problem. And then after you've done that, well, what do you have now? You have a model that can predict returns on some market. And so then you say, how do I actually turn that into money? Well, there's a couple steps before then. The first step is you need to actually turn it into portfolio weights through that mathematical optimization process. So this is kind of known as portfolio design. And then you have to decide how you're actually going to execute it. Because you can think of it as like every given point in time, you have a portfolio. The portfolio maybe you own nothing, or the portfolio maybe you own 100 shares of everything in the market. It doesn't matter. You have a portfolio. You do your mathematical optimization based on your model weights, and then you say, here's a new desired portfolio. Here's like what my model thinks is the best portfolio for me to be in right now. And then you look at your existing portfolio and the desired portfolio, and there's going to be some differences between the two. And resolving those differences is known as trading or execution. That's its whole own science in itself. Many different disciplines live within just like one of these squares on this diagram. So like I said, it's a very high level view. But you have to decide how you're going to construct a portfolio. You have to decide how you're going to trade it, and then you simulate all of that end to end in what's known as a back test. And the notion of a back test, I think, is often misinterpreted. Back tests are not to tell you if your model is predictive, if you have an algorithm which is predictive of what's going to happen. That should all have happened before when you're doing your exploratory analysis and out-of-sample testing. A back test is to tell you whether or not the returns of your model, the predictiveness of your model, survive all of the frictions that you're going to encounter when you're optimizing your portfolio and doing your execution. And we'll get into that in the next section. But then after that, of course, then once you've determined that it's still making money in the back test, then you would usually kind of paper trade it or back test out of sample, or run it with a small amount of capital just to make sure that everything is still looking good. And then you would live trade and start ramping up the amounts of capital. So that's generally the process for going from an idea to a full algorithm at a very high level. And I want to flip the perspective now because I think this is really important to go over. So this is the perspective 2 of 3. And I made this diagram because it's a different way of looking at the same process that we looked at before, but it points out something which I think is really important. So again, step 1, you come up with an idea, and then you use that idea to create a model which is predictive of returns in some way. And then you have predictions, basically like desired weights. You have some function which allows you to say, for a portfolio, how much should this portfolio return? And that gives you what's known as the information coefficient. I'm not a huge fan of like industry level jargon. I find that when every industry comes up with its own jargon, there's just a lot of like renaming unnecessarily. So what this really is, it's known as the information coefficient amongst quants, but what it really is the correlation between your alpha and future returns. So here I'm expressing that as the C of A and R, where A is your alpha and R is your future returns. And alpha is just the canonical way of kind of saying these weights. You could also call them predictions. I didn't want to call them predictions. I wanted to call them predictions, but then that's confusing down below because you're going to have portfolio, which is also P. So I chose A, which is alpha, which is kind of canonical. And so really, again, it's the correlation between your predictions and returns. And if this is positive or negative, it actually doesn't even matter. If this is non-zero, you're in good shape, okay? If your predictions have information about future returns, you're in good shape. That's a really good first step. But like I said, it does not correspond to money yet. So what are the next steps? Getting down to money. So then you're going to take your risk constraints and combine them with your predictions in your portfolio optimization process. And that is going to give you constrained portfolio weights. So what I mean by that is that if you had no constraints, you could kind of have a perfect fidelity between your desired, your predictions and then your actual portfolio weights. You can't do that in real life because of constraints, position concentration risk constraints, sector risk constraints, common factor risk constraints. There's a lot of risk constraints that you generally have to abide by in real life. And so because of those constraints, in any negotiation, you're not going to get what you want. And so your outcome portfolio weights are not going to be quite the predictions that you made. So there's going to be some degradation in quality there. And when you come out your portfolio weights now, will have their own correlation, but with future returns, and you can see that expressed on this diagram. And that is usually going to be lower. And what's known as in the industry, it's known as the transfer coefficient. How much of the predictiveness that you had before you did your optimization transfers over post the optimization. It's important to know like how much you're losing on that step, because you find to get to the end of the process and you're not making money, you want to be able to go back and debug where did it fail. Because if it failed at the step that your original model was never predictive, fine, then you can come up with a new model. If it failed at the step that your weights were not predictive, then it means that maybe your optimization is wrong, or your risk constraints are too strict, or that your model is just good without constraints, but in the real world, it's not going to work. Finally, there's like a third tier here, which is then you're going to have execution constraints, right? So everybody has real world execution constraints. How fast can you trade? How much can you trade? How much capital you're trading with? Large institutions who are trading large amounts of capital actually have kind of these inverse execution constraints in which they have trouble trading they have trouble because they're trading too much. They're moving the market against them. Small traders may not be able to buy into a ton of names before the transaction costs start eating up a significant portion of their capital. You have your execution constraints, and then you combine them with your portfolio weights, and then your portfolio execution process, whoever's trading your portfolio, automated or manual, will give you your actualized portfolio positions. That is where you actually make money, because then there are real positions held in a real brokerage account, and if they go up, you can liquidate them at some future point in time. Obviously, there's going to be friction on the liquidation as well. We'll ignore that for now. My point is that if your actualized portfolio positions, expressed as kind of weights again, are correlated with real future returns, you will make money. That is like at the end of the day, that is the fundamental kind of like real prediction that you care about. So again, there's obviously like all of these boxes have costs associated with them. There's costs to do trading, there's costs to come up with ideas, there's costs to test ideas. So, obviously, like, it's not like this thing just has to be like a tiny little correlation, you're fine. You need to have it be a robust enough correlation that it can survive all of the costs of your system. But at the end of the day, the way to think about it is you start out with correlation between your predictions and future returns. Those are going to get, mangled a little bit in portfolio optimization. So you'll have a lower correlation between portfolio weights and future returns. Those weights will get mangled a little bit in the execution process. And the final correlation that really matters is correlation between portfolio positions and future returns. And if you need your initial correlation between predictions and future returns to be pretty high to survive the various levels of effectively discounting of mangling that it's going to have to go through. So like I said, in general, you need in general, the correlation between predictions and returns is going to be the highest, You can have weird effects in which maybe the optimization would actually like make the returns better, but if that's the case, I suspect that you're just dealing with noise and there's no actual signal there. So again, just to quickly recap on this point, I've said it before, but I just wanted to show up in this slide. You start with model predictions, and if they could magically be transformed into positions, then all you would care about is the correlation between your predictions and future returns. That's not the case. So you have to optimize to get to weights, and if those could magically be transformed into positions, that would be fine, but they can't. So you have to execute and get to real portfolio positions. And then, and only then, if there's remaining correlation that hasn't been stripped away, will you make money. So you kind of have to start from a pretty good place in terms of predictiveness to get down to a place where you're still making money. And when I say pretty good, I mean at the end of the day, quants still have pretty low predictive power in terms of rarely getting over more than 60% accuracy, I think. But it's just about understanding how much discounting you're doing at each step. And of course, there's a whole other host of work which is done to reduce the discounting and make better optimizations and have better and cheaper execution. So there's, you can also work on the cost. You can also work on having less of a discount as opposed to trying to make the initial thing better. So here's a final perspective on it, which is just a different perspective. And then I'll actually talk about some real tools briefly. The final perspective is you start with data and you define a universe in which you want to trade, because at the end of the day, like, you want to be trading within a universe that you believe you have an advantage in. If you think that you can price energy stocks better than other people, only trade energy stocks, right? Like, don't kind of go into a universe in which you don't think that you can win. And then from that universe, you come up with a bunch of different models, again, canonically known as alphas. Those are combined in some intelligent way, and those go over to your portfolio construction. The data also drives your risk model, which tells you how much risk you're taking on. It drives, well, it doesn't. Sometimes it drives your objective function, depends. But at the end of the day, your portfolio construction is going to take in your constraints, your objective function, usually, like try to maximize my returns, your risk model, and your prior portfolio, the one that you're currently holding. And it's going to spit out your ideal portfolio and then kind of take the difference between the two, and that's your trade list, which is going to be sent to execution. So again, even if these are perfect, there's going to be a discounting in this portfolio construction step, and there's going to be a discounting in this execution step. So just, keep an eye out for that. So towards that end, obviously, Quantopian's main mission is to enable anybody from around the world to, write a trading model, a trading algorithm from scratch, regardless of, where they're coming from on this. And so we have a ton of education, but we also have a ton of tools that are available on the platform. So for checking to see if you actually have correlation between your predictions and future returns, we have a tool called alphalens. For simulating that full back test, once you have your full model and all the trade and execution set up, we have a open source free tool called Zipline. And for analyzing backtest results and determining how much risk you're taking on, we have a tool called pyfolio. So we have tools that pretty much cover all these steps now. And again, like, they're available on platform with access to a bunch of data, but we also make them free and open source, and there's a big community of people who use them on their own in various different ways. So we're a huge fan of open source software. It's kind of always been part of our core mission statement. And towards that, I just want to give you a quick preview of how some of that might look in real life. So for alphalens and checking the correlation between your predictions and future returns, you're going to see a lot of plots like this. And I'm not going to go deep into these plots. I just want to kind of tease these a little bit. And if you're interested, like I said, there's links I showed earlier on this slide you can follow. There's lectures on this. There's lots of materials you can look at. And this is, for instance, an example showing if you group stocks into buckets based on your predictions, what are the daily returns 1 day forward, 5 day forward, and 10 day forward. So this is a really common plot that you're going to see a lot of different quant analysis use, trying to understand how your predictions are actually spreading stocks out into different tiers. You'll also look at things like that information coefficient that I was talking about, which is actually really the correlation between your weights and future returns. You can look at it in distribution. There's all sorts of quantitative analysis that you're going to do on that. And the point I'm making here is just like, again, I was going at a really high level. There's a lot of deep statistical analysis that goes into any of these steps. On the next step, I'm not going to show any plots from Zipline. That's a little bit more involved, but it's out there and it's kind of the core backtesting engine on the website. On the next step, you're looking at something like pyfolio. Here you can, for instance, see once you have a full backtest, one of the most interesting ratios that people use is called the Sharpe ratio. Sharpe ratio is basically just signal-to-noise ratio for a full trading algorithm, which is the average return it gets over the variance in return. And you can see here, real Sharpe ratios are pretty noisy. And this is I don't actually know the algorithm that generated this. I think it's one of our sample ones. But you can see kind of things like over time, how is the signal to noise ratio of the algorithm changing? Is it getting better? Is it getting worse? Is it being affected by different events, etc.? You can also look at like distribution of returns month over month and annually and all that kind of interesting stuff that you would really want to understand about an algorithm. So again, point being, there's a lot of deep statistical analysis that you can do. Quantopian has tried to release free and open source tools that you can take and modify as much as you want or just use out of the box. But you can go pretty deep into any one of these subjects, and there's people who spend their whole careers, focusing in on very specific ways to understand Sharpe ratio or optimize portfolios. Another really important point that I want to make here, just towards the end, is something that's really core to all of this, which I think is oftentimes under-realized, is a lot of quant and science is about making yourself blind to biases. So humans are, tremendously error-prone and bias-prone. We have all sorts of, ways that we think that hurt us and others in various different ways. And a lot of science is trying to remove that from the experiment process because those get in the way of knowing what's true. And quant is a subject in which you have to know what's true, because if what you're basing your decisions off of is not true, you're going to lose yourself or someone else a lot of money. So one story that I like to tell is an example of why, in general, you actually want to try to make yourself blind to these biases, like purposefully put blinders on so your brain can't even use that information, is orchestras. And back in the mid-20th century, orchestras were predominantly male. And kind of had always been that way. And just with any field, the same explanations were given that, oh, maybe women were just less suited to that work, or maybe women had other stuff going on in their life which made it harder for them to be players. Like, there's all sorts of sexist explanations given. And one really interesting experiment that was tried is people are saying, well, maybe it's actually that the audition people are sexist. Maybe it's not that women are worse. Maybe it's that the people who are doing the auditions are making decisions they don't even realize subconsciously based on whether or not someone's a woman, sometimes consciously. So what they did is they said, okay, let's put up a screen and we're going to have everybody who's auditioning play behind the screen. We don't know who they are. We're just going to listen to the music and then we're going to make a decision based on that. And that almost worked, except amazingly, some bias persisted because auditioners could tell if it was a man or a woman based on whether or not they could hear the high heels clicking on the floor as they walked in. So this is an example of like how pervasive bias can be. So they actually also had to put down carpets. And it turns out once they had this carpet screen system in place, then they started making pretty 50-50 decisions. Like orchestras diversified very quickly in terms of, I guess the cosmic scale. It still took years and years, but by and large, there is a huge increase in diversity. And nowadays, if you look on TV, you don't expect to see all men in orchestra. You expect to see a pretty good mix. So I think this is a really good example of why, in general, you want to kind of on purpose figure out what your biases are and then make yourself blind to them. And it's hard because oftentimes biases are things that we express as beliefs, or kind of like things that we're defensive about. But quant is important. It's really important to get rid of these biases as much as possible. And as an example, like this is something that we at Quantopian have tried to do when we're selecting strategies to make allocations to. We're completely blind to the person who developed those strategies. We look at the strategy in isolation, we examine the strategy, we do a lot of statistical analysis, and then we make a decision about whether or not to talk to that person. So we try to make ourselves blind in that way so that we don't bias ourselves. And towards that end, we've actually started to see really good geographic diversity. I think we've so far made allocations to people on over 5 continents, which I'm really happy about, and I'm hoping that we can then start to expand all sorts of other types of diversity, and that's kind of the end goal for us. But in general, making yourself blind to your biases is really important and can be really helpful. So again, like I said, for more info on everything here, there's a whole lecture series that you can go to at quantopian.com/lectures. But otherwise, again, just going to slow this disclaimer again for good luck. And if you have any follow-up questions, like I said, I'll take some questions today. But if there's questions that we don't have time to get through today, you can get in touch with me on Twitter at @TheStreetQuant. We're at Quantopian on Twitter. It might be better to tweet at Quantopian because I actually don't check my Twitter that much, embarrassingly. And then, like I said, there's the whole Quantopian.com/lectures. So I have some questions that have been queued up here. So I'll attempt to answer as many of them as possible. And the first question is, what's the business model behind Quantopian? So Quantopian's business model is we make allocations to people who develop really good strategies on the platform. So again, we provide all of these tools and data on the platform for free. We provide a community, where you can go and ask questions. And our business model is we want to provide allocations to the people who are making the best, and then do profit sharing on that. So trying to give you basically a fair share. As opposed to kind of the fund model, in which generally, starting as a quant, you wouldn't even get a share of returns until you're fairly senior in the firm. So anybody at Quantopian who writes something that receives an allocation just automatically is going to get, barring there's terms and conditions about holdbacks and whatever, but is automatically going to get what we target is 10% of the returns, and which we think is a pretty good deal, but obviously that's up to you. Number 2 is talking about alpha and beta, and asking about what I think about alpha through the lens of new factor investigation. So this is a very, very broad question. I could probably talk about a lot of different things here. In general, the way I think about alpha is what is unexplained by the particular factor model you're using. And the amount of alpha you have is very sensitive to what factors you're using. And true alpha that is uncorrelated to everything you could possibly find is probably fairly rare, especially because you can always find something that's correlated because of multiple comparisons bias. So in general, the question that you come up with is every model can either be alpha or beta or some mix of the two. And alpha is really relative to the risk factors that other people consider important at the time. So it's kind of one of those very overloaded terms. We're saying that a model has alpha, means one thing to someone and one thing to someone else. In general, the way I think about alpha is if you come up with something which is legitimately new and interesting and based on kind of new data in some way, that has the highest chance of having true alpha. And all we can ever do is kind of try to estimate how much alpha and beta it has through linear regressions and other analyses. So I may have completely not answered the question that you had. And I'll be happy to answer more specific questions later, especially if you post them on the Quantopian forums. I think that would be also a great way to involve other people. And like I said, any of these questions, if people have follow-ups, like I said, Twitter or actually the Quantopian forums, because then you can have pretty interesting debates with other people on the internet who you may know or not know. So number 3 is, where can we get free, cheap data source for backtests? Well, I will say in a very biased fashion, Quantopian. Quantopian gives you free data and the whole backtesting infrastructure to go around that. If you want to do your own backtest, or you want to backtest using signals that are maybe you've made yourself, Quantopian's working on giving you more and more features to do that. But as far as cheaper data sources, I don't have an easy answer for that off the top of my head. Like I said, all of my expertise tends to be within kind of the stuff that we do at Quantopian. I have not recently gone out and tried to build my own trading system, so I would not know who's the best provider right now if you want to purchase your own data. And that's just completely on ignorance on my part. I have no idea. So 4 is saying what's the time scale for a model in the context that I'm talking about, days, weeks, months, years. And the answer is they kind of answer it themselves. Well, really the time scale can be anything. Every model is different over a different, every model is predictive over a different time horizon, right? Some models can tell you more about what's going to happen tomorrow, and some models tell you more about what's going to happen next second, and some models tell you more about what's going to happen 3 months from now. So every model's different. You have to understand that when you build your model and kind of be intelligent about that. And the thing to remember is just that with real world, being real world, if you have a model that is predictive over what's going to happen next year, you're going to have very low sample size for that model. So you're going to have a lot less confidence that that model is actually doing what you think it is, because you've just had so fewer iterations of that model working or not working. So in general, you get the highest confidence if the model is trading quickly, just because you have more and more samples that you can draw out of that model. So the types of models that Quantopian targets for allocation are models that are kind of more daily in terms of execution. So any information on how to apply this to Bitcoin and other crypto assets? Great question. The answer is no difference. Everything that I said was completely generic, and it just referred to the process of making a model that predicted movements of some real world thing and then being able to trade that real world thing. You could swap in any kind of mechanism, whether it be a brokerage, your own homespun system to trade crypto assets, and you can swap in any model that tries to predict the motion of cryptocurrencies. I think you should apply the same best practices when moving into a new space like that. Just keep in mind that the types of models that are used in quant finance oftentimes think about things like underlying value, which is something that doesn't really hold in cryptocurrency. So you would probably want to look for more kind of closer cousins in, for instance, the foreign exchange trading spaces, or maybe looking at derivatives trading and futures trading if you're trading the Bitcoin future, to try to come up with ideas for models that are actually going to predict movements in cryptocurrencies. By the way, I'm going to keep going through these questions. So if there's a hard cutoff time, someone please let me know. But there's next question, which was, for the third model approach, why would you use the difference between the prior portfolio and the current one for execution instead of just the current portfolio? Well, that's a great question. I'll actually go back to that slide just for context. So the question is saying, in this view, why do you use the difference between the two for execution? Well, the reason is because if you are already holding the thing that you want to hold for a particular asset, if you're already holding 100 shares and the new portfolio is the ideal portfolio is 100 shares, then there's no difference and there's no required change. So there's no reason to send that over to the execution department, because they would just say, I'm going to do nothing. It's a no-op. So the answer is just if you're already at the place you want to be, you don't need to do anything. So that's why you use the difference. You just say, how am I different from where I need to be, and how do I get there? Next question is, so once the backtesting is done on the Quantopian platform, how do you bring it live for oneself? So that's a great question. It depends on what type of model you're trading. If you're trading a very institutional model, which is kind of a very large scale, buys and sells many assets, large capital type model, the best practice to make money off of that is most likely to try to sell that to an institution who can buy it and use it. Because again, remember, the value of a model is relative to how much money you can make off of that model. So, if you are trading a model on $100,000 and it's making 10% every year, well, you're making 10K every year, and that's a fairly large capital base for an individual. And that's a fairly also low amount for an individual compared to what you might make off of your, regular job and your salary. So, the value add of developing a model, I think, oftentimes tends to be better the more capital you have to deploy to it. That said, there are a bunch of integrations that people have been developing. I think Zipline Live is the one that we point people to, but I don't want to don't quote me on that because I'm not sure right now. But I think there's Zipline Live is one of the ones that we point people to. And there's a bunch of integrations where people can actually trade, I believe, through interactive brokers using Zipline. The constraint is just that you have to get your own pricing data if you want to do that, to be able to actually run that. Because on the Quantopian platform, it's all insular and right now, and the goal is to maximize the chance of getting an allocation. Quantopian allocation sizes, by the way, we try to make those big enough that if you write a good strategy, we can actually allocate you an institutional size amount of capital so that your share of that is going to be meaningful. We try to make it at least 10x what you could deploy yourself, so that the 10% performance fee you're getting is more than what you could get on your own. And I think from what we've done already, it's definitely at least 10x what most people could deploy on their own. So is there an article summarizing the orchestral metaphor I used? Yes, it's actually on the slide, so you can check back later in the video as well, or I'll just display it now. This is where I cited the source here. I think there may be other articles on this as well, but this is the source I cited. It's from a news article on actually I think it's the Daily Princetonian website or something. And another question that I'll answer here is, how do I see quantum computing affecting the role of quantitative finance? Well, like anything else, quantum computing is just a new technology which is going to do two things. It is going to make certain processes automatable in ways they weren't before, and it is going to make completely new approaches and techniques available. So it's basically going to, and it's hard to foresee the second one. Like if you can foresee the second one, go out and do it because you'll make money. The first one, I think, where it's going to help make current processes faster, not cheaper at first, but eventually, current processes faster, is optimization. So quantum computing is really good at optimization. That's what it does really well. And so what it's going to be able to do is basically just make much better optimization over more variables. It'll also probably enable things like being able to read more data, do faster trading. So, but the big thing I think it's going to initially affect is optimization. And if you look at all of kind of the current quantum computing providers, that's the problem that they've targeted. So systems like, I think, D-Wave and a few others have built basically like optimization chips. So that's what they're currently being used for in finance. There's actually a paper by Marcos Lopez de Prado, who's a professor that is a friend of the firm at Quantopian, and he wrote a really interesting paper talking about kind of some baseline applications of quantum computing to finance. So you can check out his paper if you're curious. How are we doing for time? We thinking maybe like three more questions. So I'll do 3 more questions, just in the interest of time. And there's a lot more questions here which I would like to answer. Unfortunately, we'll not have time to today. But like I said, if you don't get your question answered, please follow up on Twitter or on the Quantopian forums, and I will do my absolute best, and I know that Paige and Phoebe will also do their absolute best to get an answer to those questions. So in the interest, I could do these in order, first come, first served, which might be the most fair, or I could look for the ones that are the most interesting. So 14 is an easy one to answer. Does Quantopian provide data on Bitcoin and other crypto assets? The answer is that we currently do not, but we certainly might in the future. Our data source is based on daily data. Do we have access to intraday data? Also very easy to answer. We have intraday data. We have minutely data for pricing, and then other data sets are oftentimes just like whatever frequency they're updated. So a lot of the data sets we offer are daily, but the pricing data is minutely, which is kind of what you need. So 1 or 2 other questions. So one question I can answer quickly: does the platform support TensorFlow and other types of ML libraries? Again, currently do not, but we're working on adding some platform functionality, which is going to enable people who have systems like that to be able to work with the platform better, because we definitely want to encourage more and more modern computing. So one question is, in view of the fact that models must constantly evolve as current knowledge and algorithms affect future pricing, how can a user be certain that any models developed on Quantopian will be kept confidential to all? great question. We take confidentiality and privacy super seriously. And something I didn't mention earlier, which I probably should, is that on Quantopian, you own all of your IP. We don't lay any claim to it. We have to ask you for permission to allocate to your algorithm. And you have to give that permission, and there's a whole process involving due diligence. But in terms of privacy, like, we're basically in a position where if at any point there is even like a sneaking suspicion or rumor that we were looking at people's models, or that we had somehow leaked people's models in some way, like, nobody would ever give us their model again. So, you know, beyond the fact that we want to do the right thing, and we put a tremendous amount of effort into developing the security from an engineering perspective, from a business perspective, obviously, like, to us, we realized that if at any point we screwed up the privacy and security aspect, like, we would no longer have a business. So the short answer is, you know, as with any, you know, centralized business, we're not on the blockchain, but as with any centralized business, there is a degree of trust involved with the transaction. You can read the user terms of service, understand exactly what it states about how we're never going to look at your model unless we, you know, it's a security emergency, which is basically we suspect your model is trying to hack us, which is something that happens all the time because that's how hackers try to get into our website. But, you know, at the end of the day, the way that I view it is, like, if at any point we violated the trust of a user, we would be out of a business. So we take it super, super seriously, and we view it kind of as a, you know, this is something that we just cannot allow to happen, because if we did, we would not be alive the next day. And one more question I'll answer is, where is our platform actually running? AWS, I believe we're allowed to say that, but I'm not sure. So I'm going to not answer that right now, because I'm not sure exactly, again, in the interest of engineering security, precisely what we deploy our platform on. So I would actually recommend re-asking that on Twitter or the forums, where someone can double check with our security team and let you know. And aside from that, there's a lot of other really interesting questions here, but in the interest of time, I do want to wrap it up. So if you have a question that you didn't get answered, please, like I said, Twitter or quantopian.com/posts, you'll get to the forums and be able to answer the question there. But aside from that, I just wanted to personally thank everybody for coming today. There's a lot of really interesting questions, and you know, I enjoyed the chance to be able to hopefully not confuse you too much with the stuff I was talking about. And I'm looking forward to there being more questions and more people writing in with comments or complaints on the forums. And if I got anything wrong today, also please tell me, because I also like to kind of update my presentations as I go along. But aside from that, I think I will trade off now and let I believe Cynthia do any necessary outro or anything like that.
Okay, well, Delaney, thank you so much for being so generous with your time today and handling so many questions as well. Now, a frequent question was, will we get a recording? And yes, we have been recording today's event, and we'll be sending out follow-ups shortly with the recording link, so you can come back and review concepts discussed today. And we'll also be including the slides that Delaney has been using, which have the URLs and the links that everyone has been asking for. So with that, we are going to conclude our session. Thank you all for joining today's webinar, and have a great rest of your day. You can exit using the X in the upper right-hand corner of the screen. Have a good one, everyone, and thank you.